Hello guys, welcome to yet another live stream. Wherever you are plugging in from, you are most welcome. Today's the 20th of March. Very excited. It's been an incredible day, guys. A lot has been transpiring, so I'm sure most of you are super excited as well. Today is going to be a very exceptional lesson and interaction with you. We'll be diving into the anatomy of price, right? It's a very big one. How do you trace the full journey? Where does the money come from? Where does it go? How does it move through all this infrastructure? And we're going to have some Q&A for those of you that are just coming in and asking questions. So while we get ready, please feel free to ask questions in the chat. It's live. We'll be having 40 minutes of back-to-back insight. And just super excited, guys. For those of you that are just joining my community, very, very grateful for the fact that you guys are very engaging. Many of you are hungry to learn, and it's just amazing. So let us... Before I start, guys, I would like to share this promo code with you. Make sure you're using it to get 100% on your first deposit. Check out my other socials. I usually interact there as well. I'm on Instagram, and you could also check out my TikTok. Please, in the chat, could you comment if you can hear me well? Tell me where you are plugging in from before we start. Let's see how many are tuning in. Wonderful. All right, guys. So let us take a quick look at what happened this week. All right. So this week, the market finally aligned with the macro reality. We had hot PPI coming out, producer price index, and core PPI showing inflation isn't just a temporary spike, right? But still broad and sticky. Now, the Fed Reserve reinforced that by holding the rates at 3.75%, okay? And this signaled no rush to cut the rates. Remember, we know that the plan for the Federal Reserve rates is 2%. We don't really know when that will happen and how drastic it will move, but this will affect a lot of instruments. And we saw gold yesterday. We also saw Bitcoin dump. That combination brought back higher for longer narrative, right? So pushing real yields up and liquidity expectations down. So there's a lot of disposable income, rather not a lot of disposable income. And that's why we're now seeing the delayed reaction with some of these assets like Bitcoin and gold and other risk assets settling off as the market reprices to tighter financial conditions. Now, I'm going to take you guys back here, and I would like to go through some of these little insights like Bitcoin dumping below 70. It's now back at 70. The market cap is 1.4. We have time zones as well. Ensure that you calibrated your time zones because there was a shift recently and you don't want to miss anything like that. So allow me to take you to today's presentation. It's going to be like a presentation, but I want to run through this particular topic called the anatomy of price. It's a very important one, and many of you are questioning. Sometimes your strategies are good, but you end up finding out that you're still not profitable. So that can really affect many traders, the psychology, if you don't really understand the infrastructure. Now, I want to remind you that having been through some of these institutions, having learned all this, it has taken me a while to sort of articulate myself and bring out the level of knowledge that the majority of people out there, whether beginners, whether advanced, will be able to acknowledge first of all and understand and then implement. So each section today will focus on identifying some of these key areas that will help you make better decisions. Okay. All right. So guys, the first question you want to ask yourself is, what is price, right? What is price? Price, not the number on your screen, right? Not the candle, not these candles here. And don't forget, we want to look at this from an institutional perspective, right? When you talk about price, you have to ask yourself some of these questions, right? Is it the candle? Is it the line on your chart? Is it the, what is it? So it is the real thing, like the thing that makes your P&L go up and down, right? So today, we're going to trace it from the most powerful institutions in the world all the way to the chart, okay? One line, no theories, just no conspiracies, just actual path that price takes before you ever see it, okay? So if you're just joining in, guys, welcome to the Foundation Friday. I'm your boy Tony Trades, and if you're new here, this is where we want to build foundation, right? When you hear price, don't think about it like the price of your groceries. Don't think about it, through some extraordinary lenses. Just understand what price is, the mechanics, and how the markets actually work. So today's topic also, on the other hand, is one that I've wanted to do for a very long time, because I see a lot of experienced traders making decisions based on a number they don't actually understand. Okay, what do I mean by that? We have 5 layers. We have less than 1 millisecond, right? We have 7 and $500 billion a day, right? That's the Forex market. And today we're going to go inside. So when you look at this, we have chain layers, 5 chain layers, okay? When they ask you what is price again, let the question hang for a while, guys, okay? I want you to think about it while we move forward, and then I'll get back to you to the end so that you understand the perspective that I'm trying to set. So we have a scale. We have a scale. Every session has a scale. And today's agenda, I'm going to try and structure it in 6 parts. So part 1 is what price really is, right? Why we go back to the first principles, like having a bid. You probably had of the ask, you had of the spread, right? We want to get some consensus on that. So part 2, I'm going to look at the power pyramid, right? Who actually sets the price? Who moves the price, and where you sit in that hierarchy, all right? Because I'm now talking to retail traders. There's a hierarchy, and we need to understand where we are within this game. And part 3, I'll look at the full chain, the entire chain. What do I mean by that? I simply mean that we will look at the main event, like central banks to interbanks to the liquidity provider to the broker to your chart. Okay. We also have. I'm going to look at part 4. All right. Yeah. Part 4, where we have the broker layer, and this is very important, right? If you're into academia, you could go check out my articles, some of my publications, a whole thesis on brokerage companies. And later on, I'll be getting deeper into some of the hidden secrets over there. So when you look at the brokerage layer, you want to ask yourself questions like, is it a EC? Is it a STP? Is it a market maker? How your order actually gets routed and why it matters. Right? Because many of us retail traders, if you're a newbie here, you don't really understand that if you press a buy, what is the percentage, what is your guarantee that order actually went to the right routes? And even if it went to the right routes, what are some of the requirements that you will need to avoid, damage? Now, part 5 will be looking at market sessions. It's very important to understand timing. When is liquidity actually real? Right? You can see these things on charts. And institutions, once again, just use the charts for a visual sort of recognition of patterns and things like that. So when should you be trading? And lastly, the application. That will be part 6. How does everything we've covered today change the way you read every single candle going forward? So if you stay through it all, guys, you will not look at price the same way. Believe me. All right, now I'm going to go to these, I don't know if you can all hear me or see me. Just put a plus wherever you are jumping in from. All right, guys, let's start quickly. When I talk about price, most traders will say it's the number on my screen. It's where you can buy or you can sell now, right? And that's not wrong, but it's not complete, right? A price is, let's see, right? So this is what we're going to cover. So a price in simple terms it's an agreement, a temporary consensus between a buyer and a seller, right? Every single time you see a candle form on your chart, what you're actually watching is thousands, sometimes millions of individual agreements between buyers and sellers compressed into one bar, open to close, right? So that is what price is in simple terms. That is what price is in simple terms. Let's see. All right, please put a plus if you're with me. You can ask questions live. I want this to be very interactive. We have a bid and an ask. The bid is what the buyers will pay, okay? Bid, buyers. The ask is what the sellers want, okay? And when these two numbers meet, a transaction happens. You always buy at the ask, right? And you sell at the bid. So next up is a spread. The difference between the bid and the ask in pips, right? That little gap is your first loss on every single trade, right? So spreads are normal. Before you've gone a single peep in any direction, you call that some kind of commission. And here's something most retail traders never think about, okay? Who's on the other side of the trade? You have to ask yourself that question. Who is that? Who is that making those decisions? When you hit a buy, someone had to sell to you. Now, most people assume that it was another retail trader on the other side. Now, that is one other myth that I would like to break down. It wasn't. It was almost certainly a market maker, right? Get that very well. An institution managing their own inventory, who was perfectly happy to take the other side of your position. Now, volume comes into play here. If you've been trading for a while, you probably might need to rewatch this video to get and absorb and digest what I'm talking about. So one more thing is your chart is always history. If you look at this chart here, this is all history, okay? This is all history. It's just history. And sometimes you can call that noise, okay? By the time a price appears on your screen, it's already been set by the chain above you. You are always downstream, always. I know these might be some new concepts for you, but the earlier you start to understand, the earlier you can build your strategy around this, okay? So let us see. Let's move on, guys. If you're with me, please put a plus. Let's look at a visualized expression of a spread, okay? On the screen, you can see a live bid and ask. This is a live bid and ask, okay? We are looking at the ask that the seller accepts, and we are looking at the buyer, the bid, what the buyer pays. Now, spread for the euro and US dollar is in between these two prices, right? The spread currently is 1.2 pips, tight, right? Now, the green side on the left, that's the bid, what the buyers will pay. The red is what I just explained. Now, the cost that you pay the moment you enter the trade, right, is the spread. Hope that's clear. Now, I want you to understand how the spread changes depending on market conditions, because this is where it gets very interesting. And if I had known some of these things when I just started trading, honestly, I would have a much better experience. So we have normal conditions, okay? The normal conditions during major sessions that overlap, okay? Remember we had this this global chart, and you can see some of these sessions on a smaller time frame. So these sessions between, say, London and the New York session, right, where they overlap, right, that spread is around 1.2 pips. It's very tight. We call that tight. Now, the LPs, that stands for liquidity providers, are competing for your order flow, and we call that an efficient market. Now, watch what happens during a major news event like NFP. NFP event, we go to that, the spread widens, okay? The spread starts to widen. Right. Now, why does it widen, right? Major news events like NFP, it just jumps from 1.2 to 4.8 pips, right? And it can vary depending on the hierarchy. Now, nearly 4 times wider. This isn't random, guys. The liquidity providers upstream are withdrawing risk, all right? They're pulling quotes, they're protecting themselves. The cost gets passed down the chain directly onto you. Okay, let that sink in. So if you're just joining in, guys, again, this can be a very important video for you. Let us look at the London Open. Okay, what's going on with London? When we talk about the London Open here, we have 2.1 pips. It's good, but it's not peak, right? Asian, for example, has 3.5 average. We're looking at average. Few LPs active, right? Less competition. So your access to price gets more expensive. A rule to remember, guys. Remember this. A widening spread is not just a cost, right? It's a signal. When you see a widening spread, something is changing upstream and you have to pay attention. We talk about all this. We delve deeper into the mechanics, and by the end of this, you'll have an idea. And of course, as we move forward, I'll be chipping in and bringing you guys some kind of awareness. So if you have an aha moment here, you could also put a plus. Let's move forward, guys. Who controls price? I want you to look at this power pyramid, right? We need to understand who actually controls price. And this pyramid is how I want you to think about it today and moving forward, okay? At the very top, we have central banks. The Fed, ECB, BOE, Bank of Japan, Bank of England, and all the top dogs, right? They don't trade in the traditional sense. They set the conditions. They set the rules. When the Fed speaks, for example, trillions of dollars reposition based on their words. That repositioning is the price move you see on your chart days or weeks later on. All right. Some of you say pricing in and all that kind of talk. So below them is tier one institutions. Think about the JP Morgans, the Goldman Sachs, HSBC. We have hedge funds, sovereign wealth funds. All right. All that. They take macro views and execute them at enormous scale. So when they buy, price moves. Not because they're smarter than you, just because they're just bigger. All right, we're going to move step by step to where we are actually found. Now, below the tier one, we have liquidity providers. Now, this is where things get very interesting. We have liquidity providers and market makers. Now, these are the silent participants most traders never think about. We have Citadel, we have Virtu, we have XTX, the UBS FX desk, and all that. They're not predicting any direction like you and me. They're profiting from the spread, what I just explained previously. Constantly, consistently, on both sides, whether you sell or whether you buy. And they're almost always on the other side of you retail traders, right? So it doesn't matter if gold just broke an all-time high or just broke a all-time low. It doesn't really matter. They take the opposite side. Right, now below them we have retail brokers. We have retail brokers, all kinds of retail brokers. And even the one that I'm using now, Pocket Options. Now, this is also a very critical point because their model matters enormously, right? The model of a broker matters, and there's a reason why I use Pocket Options. And we'll cover that in detail shortly. At the bottom, ladies and gentlemen, are the retail. The last in the chain, the smallest participants by volume. And that is where you are at the moment. But here's what I want you to take from this pyramid. Being last over here doesn't make you powerless. Think about that. It gives you clarity. If you understand what's happening in every layer above you, right, you can trade with the flow instead of into, right? So the pyramid is your roadmap. This is your roadmap for the start. Now, a point to take is have this visualized, and as you start to trade moving forward, I want you to think about all these institutions, where you're placing your trade, and think about not just institution, but the technology that they're using. And the next time you want to risk and you don't understand your entry or exit, I want you to put that in your mind, okay? Let's quickly move on to the policy layer. The policy layer. I want you to now zoom into the top of the pyramid, right? We looked at the central banks. The policy layer, because everything below it is downstream. So on screen, you can see that all right, let's see. Okay, there we have it. So on screen, you can see that the current Fed funds rate, we saw 3.75%, right? Let us look in more detail, right? That single number, right? If, okay, let's assume it's 5.25%. Let's just assume that. We know that it's 3.75%. But anything below that, let's say if they shift this rate down 25 basis points, right, from the last meeting, that single number, that expectation of where it's going is the most powerful price driver in all of Forex. Full stop. That's why I really emphasize fundamentals. I talk about interest rates. You see me breaking down all these indicators. There's a reason for that. Now, Here's how the mechanism works, okay? Guys, don't mind me, I got a little cold. So here's how the mechanism works. When the Fed hikes the rates, holding US dollars becomes more attractive, okay? And vice versa. Capital flows in from all around the world to earn that higher rate. So demand for US dollar rises, okay? And the euro US dollar can fall. GBP US dollar falls, every dollar pair adjusts. Now, when the Fed cuts the rates, for example, the opposite, cheaper borrowing, capital flows out of the US dollar and into risk assets, equities, commodities, emerging market currencies, and so forth. But here's the thing most traders miss. The decision itself is often less important than the language around it. So you've probably heard about hawkish, dovish. So this kind of English is pretty much getting the sentiment of what these leaders are saying. So the dot plot, the statement, the press conference, higher for longer, became a trade signal worth hundreds of pips before even a single rate move happens. And look at the rate table on your screen here, okay? For example, you've got Fed at 5.25. We know it's 3.75. Look at ECB. We've got Bank of Japan and all these other rates, right? So the differential between these rate drivers, the long-term direction bias of every major pair, this is not optional knowledge, guys. This is the market. Every pip on your chart is downstream of a central bank decision. Sometimes by hours, sometimes by weeks, or even months. So that is something very important to also place in your mind. And as you trade your technicals, it will start to make sense. All right, guys. Now, beyond the central banks themselves, beyond the central banks, we have macro forces. All right, macro forces that drive the top of the pyramid, and all four ultimately flow back to the central bank expectations. We have monetary policy being one of them, the rates, QE, QT, right? Forward guidance. I've already covered this in detail, right? This is the alpha driver. Everything else gets filtered through it. That's why I emphasize fundamentals. Next up, we have geopolitics. What is happening right now? Wars, elections, sanctions, tariffs. When genuine geopolitical risk spikes, capital flees into safe havens, right? Like the Japanese yen, the Swiss franc, gold, and so forth. You'll see massive correlation shifts in currency markets during geopolitical events. That's why I emphasize seasonality. So you've seen the Russia-Ukraine military operation, the Middle East now escalations. You've seen how you could see this on your screen, right? What's happening with oil, right? And all the other assets. Now, there aren't just news events. They're structural repositioning triggers. Now, we move on to inflation data. This is another important one. Inflation data. CPI, PCE, PPI. Why does a CPI print move Euro US dollar 80 pips in 30 seconds? Why? Because traders aren't reacting to the inflation number itself, but they're repricing their expectations of the Fed's next move. So a hot print implies a hike, a cold print implies a cut, and so forth. Markets trade the implication. And next up we have the employment data. This is next wave. We have NFP, unemployment rate. Strong jobs means sticky, inflation means higher rates, and all that kind of language, right? That's a chain. Every Friday morning, the market reprices the chain in real time. So by the time all these events hit your newsfeed, institutional positions are already priced. So you're trading the second wave. So the key insight, guys, is when I talk about the second wave, right? It's a concept in a mental model shift that experienced traders will appreciate. So this is an advanced lecture. I teach at the university, and we usually go through some of these topics. It's good to understand the theoretical part, and then you can transpose all that into real executable strategies. So ask chart, the ask and the bid, right? For example, depending on your brokerage that you're using, you'll be able to get the feel. Okay, guys, let's move to the interbank market. Now, interbank market is another very interesting part that I wanted to share. We're going somewhere where most retail traders either never go, they've never heard about this. Maybe they heard about it, but they just don't pay attention, right? So most of us that have had the privilege to work behind the scenes, we get to interact with some of these infrastructure, like the interbank market. So this is where the real price is formed. On your screen now, here. Let's see. Are you with me, guys? Are you still with me? Yeah, on your screen you can see 5 of the biggest players, all right? We have JP Morgan, HSB in London, Deutsche Bank in Frankfurt, Citi globally, and Barclays in London, okay? These institutions are trading directly with each other. No retail broker in between, right? No markup, just raw price, right? You will have access, rather, you will never have access to this market. The minimum ticket size is, say, $1 to $5 million per trade. So let that sink. $1 to $5 million for one trade. The spreads are 0.1 to 0.3 pips compared to the 1 to 3 pips you see on your broker. So the markup chain between you and the interbank rate is very real. You do the calculations from 0.1 all the way up until 3, right? And the compounding effect through every layer is very significant. This market runs on 2 main platforms, okay? Reuters matching and EBC, okay? EBS rather. Think of them as the stock exchange for banks. Now, that infrastructure doesn't use brokerages, right? They use other platforms, right? And if you're working in one of these institutions, you will use a totally different platform. So you can imagine, you can ask yourself a question: why do institutions not use the same instruments that you use, like candlesticks, for example? The answer is right there. $5 million per trade. You're not playing games, right? You have to read the tape. You have to understand the price. You have to have interbank dealer ranges and so forth. So this market runs. You have to know the infrastructure, right? If you've ever heard of Bloomberg Terminal or Reuters Acorn Screen, those are how tier 1 traders see the interbank rate. That is not your MT4, that is not your trading view, right? And so forth. And these are softwares that these institutions pay hundreds of thousands of dollars to use. And very few retail traders have access to these. You have to be licensed. You have to have quite a significant amount of money to tap into this liquidity. But here's why you need to understand all this, guys. I keep mentioning this, not because this is free. I'm not charging anything for anyone. This is knowledge that will really help you. Everything you see on your chart, every peep, every candle, every move is derived from what happens in this market. When you see a massive move after an NFP print, you're watching interbank repositioning filter down through the LP layer and the broker layer to your screen. It's not random. It follows a chain. And that is the message I want to deliver to you guys today. And one more thing, guys. When institutions trade, they trade size. A single order at this level, okay, can visibly move price. That order becomes the wick that you see on your chart. That wick is not random either. Okay? That wick is not random. The wick is not random. Think about it. Any wick that you see on your chart, it's not random. So it's very powerful. Let that land, right? Let it land for. Anyways, we'll move into that for the advanced group. I will explain to you in stages. Don't want to blow your heads with lots of noise. So what is the time? Oh, we're running out of time. All right, reading the order book. So we have let's look at how price is actually let us look at how price is actually formed. Let's look at how it's formed at the execution level. This is the level 2 market depth. We call that the order book. On the left here, on this left side, the green side, okay, we have buyers stacked at different price levels. 1.08, blah, 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 all the way down, right? While on the left we have, on the right we have asks. Sellers stacked going up. The best bid is 1.08568. Okay. While the best ask. While the best bid is 8556. The spread in between those two is 1.2 pips. The midpoint is 1.08568. 62 midpoint. Okay. Now, here's what actually happens when price moves. When a large institution puts in a market order to buy, remember the $1 to $5 million. It doesn't just feel at the best ask. If the order is very big, it eats through multiple levels. It feels at maybe a portion at 1.0856 to counter who is selling or buying, and then it moves up to 1.08576, and then to 1.08584, etc. It keeps going up. Each level consumed. That's what we call slippage. Slippage at a structural level. We're looking at real slippage at the top of the hierarchy. Let that sink in for a while. There's no manipulation there, just the mechanics of a large order running through available liquidity. Yeah, today's quite a lot of interesting stuff. So, this is exactly why you sometimes see price spike 5 or 6 pips in a second on a news event. A massive institutional order just ate through 6 levels of book simultaneously. Every level consumed quickly, created more price movements and so forth. So volume at each level, notice the volume numbers: $2.4 million, $5.1 million, $8.7 million. The deeper you go, the more liquidity builds. This is called the wall. When an order runs into a wall of volume, price stops and often reverses. That is what you see as your resistance. Unfortunately, very few retail traders can explain this. The order book is the anatomy of price formation in real time. Every candle you've ever traded was built by this process, millions of times over. Okay, guys. So time is up, and I think we shall continue this lesson next week. We'll start from liquidity providers. So it's going to get more interesting, and I'm sure you're going to like this. So we'll start from the liquidity providers. Okay, tier 3. I'm going to crush tier 3, and this is just the tip of the iceberg. If we start to dig deeper into every one of these levels, it gets very interesting, and I'm sure that if you're passionate about economics, you will see the market differently. So when it comes down to any strategy that you see me doing, there's a reason why I have chosen a particular instrument, the time, the indicator, or whatever, to bring the best possible outcome. Do you have any questions, guys? All right. So I'm going to stop there for today. Once again, remember to subscribe. Check out my my socials. Use that promo code to get 100% on your first deposit. It's going to get very interesting. I'm really excited for most of my people joining in. Students are there are lots of feedbacks. Guys are making money. Guys are seeing things different, and I'm glad. It's very good to give back to all of you. So see you guys in the next session. It was nice to see you all. Cheers.
My heart is catching fire. I just feel so fine with this fire, this fire.